Hi, everybody, and welcome back to yet another cracking installment of the Matt Brown Show. This is the Private Placement Perspective series where we're talking about venture capital and all sorts of cool things about venture stage investing. And with us on the line from the Bright Lights of Maine is Joe Powers. Joe, welcome to the show.
Thanks so much, Matt. Appreciate it.
Cool, man. So why don't you kick our audience off from around the world and tell us a little bit about what you guys are up to at Maine Venture Fund and how you got your start in the world of venture investing.
Yeah, sure thing. Well, appreciate again you having us, and I'm pleased to tell you more. Maine Venture Fund is a unique venture fund in that we're a state-sponsored fund. So unlike most venture funds, most of your listeners will probably know, where investment comes from individuals or other institutions, and then it's all aggregated and invested through the fund. In our case, all of our funding is state taxpayer money. So similarly, we're investing that into startups that we hope will grow and have nice exits someday, but it's all within the confines of the state of Maine. And it's really an economic development tool of the state. So pretty unique. I would say most states in the US have a model something like this. They all do it a little bit differently, but it's a lot of fun, and you can imagine a lot of coordination across other economic development entities in the state. Personally, I have been working with the fund for the last 4 years, and prior to that, I was working on all different types of startups in operating roles across marketing, sales, business development, operations, and was a part of several different venture-backed organizations. So I got a sense of what it looked like from that side of the table, and bringing that to the investing side has been really fun and interesting as well.
It's very interesting that it's a state-funded, a state-backed fund, which is super different to pretty much everyone else that I've had on the show. I've had like regional-focused funds, but they've raised or created their funds through traditional LP partnerships and things like that. So I'd love to understand a little bit more, like how does it actually come about? So it's essentially a state of Maine, right? Fund. So is it refreshed? Is it evergreen every cycle, every year, in other words, or does it run on a traditional sort of 10-year cycle?
Yeah, good question. So it is evergreen. It was created way back in ancient history in 1996. Basically, at the time, the state legislature had the foresight to say, there's some interesting startup activity happening in Maine, but a lot of the investors who are in the larger markets that are adjacent to Maine, like Boston and New York, and further afield, San Francisco and other cities, aren't really looking at startups in Maine. So we need to create something here that helps these startups get a leg up and get their feet underneath them. So that was the original idea around the fund. I believe the original allocation from the state was $5 million, and it was sort of a sink or swim. So invest this money into different companies, and then to the extent that there are returns, like you say, that's evergreen, gets recycled back into other investments. And so we've been growing organically like that over the last 25 years. And we've had some additional allocations from the state. We've had some returns. And so it's all contributed towards building the impact that we can have. And we're now making more investments than we ever have per year and writing bigger checks. And it's all still at a small scale, but relative to our modest beginnings, we've really created a nice foundation, and we've got a portfolio of 35 companies across all different sectors at the moment.
So does a state-backed fund still work on a 2 and 20 principle?
No, I work for a salary, and so that carry that would normally go to the fund manager again gets recycled. So we have an overhead, so I think maybe equivalent to the 2% management fee. We've got some expenses, in not only my salary, but my two colleagues, and we keep it pretty lean. So it's really about how do we minimize that overhead and maximize the amount that we can recycle.
And Joe, when it comes to, you mentioned you have like 30, 35 portfolio of companies. What sort of check sizes are you cutting these days? And I know you mentioned you were agnostic, different industries and that kind of stuff. But do your typical issuers need to be revenue generating? Can they be pre-revenue? Like, walk us through all of that.
Sure thing. So our Fairway investment is a company that's in the marketplace, has proven the concept, has proven some product market fit, ideally, $1 million or more in revenue, and is really looking for acceleration capital. Typically, we're investing at a seed stage. Sometimes we do pre-seed. We've started to actually do some pre-revenue as of late. So to answer your question more directly, our check sizes can range all the way from a modest $50,000 check into a pre-revenue company up beyond $250 for companies that have a little more of the risk wrung out of the proposition. And then when we make an investment, we are very particular about governance, and we can talk more about that if you think it's interesting. I certainly do, but it's something that we've seen over the course of the lifetime of the fund makes a big difference in the success or failure of these companies, a good solid governance structure. So we tend to require that as part of our investments. We often join the board as a board observer, and we typically make follow-on investments several times over a company's life on the course from original investment all the way to exit.
It's super interesting, man. And so you say this idea of a state-backed venture capital firm, it exists in, obviously there's Maine, but then are there other states as well that have the same practice? Is it universal in every state, or is it only in some states?
Yeah, it's really sort of it's only in some states, but it's really a recreation, it seems, in each state to kind of start from scratch from however they want to implement it. So our best analog is in Massachusetts. It's an organization called Mass Ventures, and they were around actually before Maine Venture Fund, but that was a little bit of a model to follow. There are other organizations down in Connecticut. There's an organization called Connecticut Innovations, and they do even more than we do in terms of their purview. But it's all, again, in this same vector of trying to help companies from a state level to thrive, and specifically, very ambitious startup companies that have the ability to provide outsized economic impact.
Mm-hmm. But your guys need to be based in Maine, obviously.
Yeah. And of course, that's a tough criteria just in terms of defining what is based in Maine, because especially in the remote first world, it's, you have a founder who's here, but they may have a team for very good reason that's across the US, and sort of attributing how much of the investment is actually going to accrue to impact in Maine is always a little bit of an interesting calculation. So that's a case-by-case basis. Of course, if there's a company that's got a big office building and everybody's coming into the office every day in Maine, it's a little bit easier. But again, that's less and less the case these days. So it's interesting.
Yes, because I know a guy who's in New York who's, obviously I know a lot of people looking to raise money these days. But, anyway, so he's like in New York, which is a stone's throw from Maine. It's not exactly, far away. So how does someone like that, who's in your neck of the woods, but technically is in New York, like, you know what I mean? But he's, and his team's around the country, do you need to have someone that's resident in Maine? Yeah,
typically we define Maine as the headquarters are based in Maine. At least one of the primary founders is in Maine, and ideally the majority of the team is in Maine. So we're kind of sticklers for that. We do try to be flexible with, let's say there's a sort of a second facility that's in Maine and there's a bunch of suppliers in Maine. Sometimes we can take a look at that. But for the most part, if you're not headquartered here and if the majority of the team isn't here, it's unlikely to have funding from Maine Venture Fund.
Mm-hmm. Okay. So look for the New York equivalent, basically.
Yeah. And I don't know off the top of my head who that is in New York, but I would guess that there are some. And many states also have within their states some regional investment or funding opportunities. And so and I think while we are the only equity investor from that's state sponsored, there are lots of other funding mechanisms within the state. And I think that's probably the same in New York as well. There's probably, especially upstate New York, that's sort of a different animal from New York City in that area.
Which budget is it? If it's coming from the States, is it like venture stage investing budgets, or is it economic? Like, where does the money come from?
Yeah. I mean, it's largely economic development. So we have a Department of Community and Economic Development here in Maine, and we're closely aligned with them. And of course, if you're a lawmaker and you're thinking about from a budget standpoint, just how do we, where do we appropriate this from, it's a sort of a bigger question, probably depending on the year and the legislative cycle. But by and large, there is a segment of the state government that's looking out for economic development entirely.
Very interesting. Had no idea. No one's ever mentioned that. So thanks for that. So I want to change gears and talk to you about the macroeconomics, Joe. Does it impact you at all when you're looking at? I mean, I know it's not your money, and I understand that the carry is not there, and like it's a slightly different context. So do you care about like what's happening in the economy and at all?
Yeah, we do. So, for example, with the latest Silicon Valley Bank implosion, we had several companies in our portfolio who were banking with SVB. So we sort of feel those same effects that probably a lot of venture funds do. For us, and I think part of what you're getting at around not being a bit isolated from the impacts that LPs might be feeling, the investors that would otherwise be investing in us that are not because we're state backed. We have less impact there, less visibility there. The biggest thing for us, though, and I think those same LPs might be making direct investments into companies, are our co-investors. So it's important to note that we're usually, and this world well, but we're usually only one of several investors in any given round. So when the economy takes a turn, or there's panic in the market, even if we have blinders on, which we try not to, but even if we're going to write the terms the exact same way, and we're paying attention to all the same things, the co-investors that we need to coalesce around a given deal are affected by a lot of those things, in some cases more than we are. So we see that effect in our deals, and we've seen everything from just slowdowns in being willing to invest in companies to compressions of multiples and all of the things, all the ways in which macro trends tend to trickle down into early stage investing.
And Joe, you mentioned that given your context, it's slightly different. In other words, if for the last 25 GPs I've spoken to, or managing directors I've spoken to, of like venture capital firms, they all say that LPs are affected by the economy. So to your point, do you find that the government, in terms of like the department that funds this sort of initiative, are they impacted when it comes to economic uncertainty at all?
It's a really interesting question. And I think by and large, they're pretty decoupled. And I would say, just in the last 4 years, in general, I might make the observation that LPs and other co-investors who are, whether they're individuals or funds that are investing alongside us, are kind of reacting in real time to what's happening in the market and to their pocketbooks. Whereas the state as a funding source, or just the state as an entity, is much slower. It's kind of like the 1,000-foot steamship. It's much slower to make turns and to make adjustments based on macro events. So, for example, with the stimulus funds from COVID, a lot of those programs were stood up relatively quickly in terms of the time in which a government can act. But those funds, 3 years later, are still trickling through and still trickling out to companies. So we are actively investing COVID-related stimulus funds at the moment. And then, of course, the infrastructure bill that passed last year, that's going to take another couple of years to filter through. So there's this lag effect with state funding, and that, of course, affects us. That's not really synced up with a lot of the private investors that we're investing alongside. So it's an interesting difference.
It is a very interesting context. Are you then like an NGO? Like, how far away are you from that type of label?
Yeah, I mean, I think it's a fair enough description. We're technically a quasi-state entity. So our board is 11 volunteers who are appointed by the governor of Maine. They ultimately make investment decisions, but they hire me and my team to manage the fund. So we're sort of a private management team working for a public fund. And if I wasn't doing my job well, they could swap me out for someone tomorrow if they wanted to, but they are serving their term at the behest of the Maine governor.
Super interesting, man. Super interesting. So let's talk about that team maybe and your experience there in terms of like when you cut checks and when you don't. So what do you look for? I mean, I know you mentioned, $1 million in revenue, all that kind of stuff. What other factors come to mind? Is it like must have a huge market, or must there be, or must they, given the fact that where the money comes in terms of like the public sector, government, do they need to be focused on like government related, enablement strategies or problems and that kind of thing?
Yeah, I think probably in most ways, this answer will be very similar to a lot of other guests that you have on the show, which is, we're looking for companies that have a really sound team and a really sound plan. And because we're early stage investors, we're typically the first institutional investor in investing into a company. We're almost, you have to rely a lot on the team. And again, hopefully there's product market fit, but there's always a lot of assumptions and risks there too, even if there's revenue coming in the door. So the question of can they get to 10x or 100x in scale, you do have to sort of read the tea leaves. And again, that comes back for us a lot of times to who is the team, what are the holes, and how well do they recognize what they don't know. The other things that are a little bit more bespoke to us are, as we already mentioned, they've got to be in Maine. But then we also look for, in terms of the exit, we're of course looking for IRR, for return on our financial return on our investment, because that helps us grow the fund organically. But we're also looking for other impacts, like job growth is really huge for us. And this is a very typical economic development metric that states and federal governments will look at. And then we look at a host of other things too. What's the demographic makeup of the team? How is the product or service impacting perhaps underrepresented populations? What's the environmental impact of the company's footprint and what they're doing for the world? So we kind of take into account all of those things in addition to financial returns to make a decision. So it's maybe a little bit more complex in that sense, but it also gives us a little bit more flexibility when, we're not quite as confident about some big financial payday down the road, but we think the company could hit a single or a double, but accrue all of these other benefits to the state and to the world, hopefully more broadly too.
Yeah, the thing I still get stuck on, it's Maine. You know what I mean? Like I keep going, I'm like, oh, that's it's Maine though. Like you have to be there. Like it sounds amazing. Like the whole thing, like the principle of it, where the money comes from, job creation, the marriage between the innovative private sector startups and, public sector capital, less impacted by LPs, given uncertain economy, you're getting stimulus, capital to invest in stuff. It's like, it's amazing, but it's Maine. It's like, it should be copy paste.
Yeah, fair enough. And I think, again, I think it is happening, and you have to know sort of where to look. These funds, these state-sponsored funds, are typically not the biggest and brightest, sort of shiny funds that are marketing themselves. They're not the Andreessen Horowitzes of the world, but most states do have something like we do. I think the other sort of maybe part of the question is, what's going on? Is there enough going on in Maine where, this is valid? And I'm sort of twisting the question a little bit, but I do want to make the point. And this is something that surprised me when I moved to Maine 8 years ago from working in Silicon Valley and venture-backed companies out there. When I moved here, the first thing I sort of had in the back of my head is, is there enough going on in Maine for this to be an interesting place for me to build my career? But also specifically, what's the tech startup scene? And I actually have found it to be very vibrant, and there's a lot of energy. I think Maine probably benefited from COVID in this way, in that it's become a little bit of a refuge state, and especially coupled with some of the kind of climate issues in other parts of the world and the country, you have people sort of immigrating to Maine who are finding it a great place to live and do work. And a lot of those people are bringing companies with them or bringing certain talent with them. That obviously is great for us. So yeah. And then the last part is, we have a geographic focus, but as you know, any investor will have their focus. So if I'm just investing in cybersecurity, that means that I can invest outside of the state of Maine, but I'm only looking at cybersecurity because that's my expertise. So everyone's got their focus.
Yeah, well, the big trend I'm hearing from a lot of VC firms today is this idea of specialization. So there's guys I know that do like specialize in companies that are involved in protein transformation, or the future of food, or whatever the case is. It's very interesting to see how it is kind of evolving. What would you say, Joe, has been your greatest success and failure in venture investing through this Maine fund? This Maine Venture Fund, and what would you say has made the difference?
I think that maybe starting with the last part first, the biggest variable for us, and I hinted at this earlier, but it tends to be, does the company from the beginning of taking outside capital have a really solid foundation for governance, for whether the board is 5 people or 7 people or 3 people, but a balanced board that has representation from the company and from investors and hopefully some independent, impartial voices, that has, structure around reporting and transparency. And that type of structure can feel a little bit maybe bureaucratic for a company that's really early stage and is not used to that. But we find that if companies can develop some muscle memory around that, it makes it a lot easier to get to that Series A and go out and raise $5 or $10 million from the investor who's expecting to see that. That's table stakes when you get to the later stages. So that's a way for us to hopefully have impact in helping the companies lay that foundational structure across different industries, because we're not coming to the table saying, hey, we're going to bring in expertise in protein structure. We're saying we're generalist investors, but we know that governance makes a big difference. So long way of saying governance is big for us. We find that it to be a difference maker in terms of ultimate success and failure. I think in terms of things that are challenging for us, there's a lot of diverse types of projects that are going on in Maine. And if you think about economic development writ large, there's $600 million aquaculture projects happening in Maine, which are hiring hundreds of people, and oftentimes in far-flung regions of the state where those jobs are even more critical. And then there's the 5-person tech startup in Portland that is trying to grow to 1,000x in scale in 5 years. And for us, if we have a given $100,000 to invest, we could put it in the $600 million capital stack, or we could put it in the $1 million capital stack for the small startup. And there's an obvious sort of opportunity cost between the two. It's not to say that one investment is better than the other, and of course, both are really critical to the state. But I think it's always a challenging juggling act for us to figure out, how do we allocate capital around the state to make the biggest, impact, and also to make sure that we're meeting all of those sort of criteria around serving the whole state and not just the tech sector in Portland.
Yeah, that's a really great point. Let's change gears for a moment. So what's your advice to a founder looking to raise money from a venture capital firm today, knowing what you know?
Yeah, I think there are sort of 2 pieces. One is, figure out whether you need venture. I think a lot of early stage founders sort of get on the bus of feeling like they're going to be successful if they can convince a venture capitalist to invest in them. And there's very much a sort of popular culture around being a venture-backed startup, and you see this, I'm sure, in your world, and I think that it certainly can be an indicator and lead to success, and oftentimes with that capital, those venture capitalists are also bringing expertise and support to the table in a lot of other ways. But it also has it could have a downside impact if the company's not ready for it, if the founders don't quite understand what they're signing up for, and just to rush into it is for the sake of it is not a good idea. And it's kind of like when you're in high school and you just assume that going to college is the next thing that you're going to do, and you don't really think about what you're getting out of it or what you could be doing differently. And it's definitely so that's the first thing I do when I sit down with a founder, is just to understand where they're at, and if they don't understand venture, to help them understand sort of what they're really signing up for. And then, from there, if we get into sort of the pitch and the back and forth and the diligence, it becomes much more around, how do you tell the story in a way that's simple enough for, in my case, my biased sort of perspective on this, tell the story in a way that's easy to understand, almost dumbing it down to the point that seems too basic for you as a founder, but know that you're in the business every day, all day long, and you're probably, pretty in the weeds. And so it's, I would say 9 times out of 10 that I hear a pitch, it's too in the weeds and not sort of high level enough. And investors are very good at getting into the weeds when they want to, but to hear the high level is the really important sort of starting place. And that tends to be hard for founders, especially first time founders that are raising for the first time.
Yeah, they're overly excited, let's just say.
Yeah, I mean, you've been there, right? You've been pitching to investors, but you probably noticed development in yourself over that time based on the feedback that you were getting.
Yeah, exactly. I mean, I think every business loves the acronyms, right? I mean, if you sign up with as a Microsoft employee, there's over 2,000 acronyms that you have to learn. You know what I mean? So your onboarding period is way extended, and it's the same idea, right? Like when you start to specialize in an industry like protein transformation, there's guaranteed, or life sciences, or psychedelics, or whatever, DMT. What's that? It's like, I don't know. Like, don't you know what that is, Mr. Investor? Yeah. It's like, well, DMT is the future of mental health, cures and interventions and stuff. Like, come on, man. But it's this natural sort of space that we tend to gravitate towards because it makes us sound different, and we know we're pitching up against a lot of other guys and girls looking to raise, so we want to be different, and using acronyms is the way that we think we should be different. Meanwhile, actually, and by the way, your point around keeping it simple stupid is a really, it's come up on more than one occasion. So most VCs are looking for simple. Just tell me, dude, like, what's the problem? Why are you the ones to solve it, or whatever, and there's always the same stuff that they're looking for, but it is this challenge of trying to keep things simple when what you're doing is fundamentally complex or hard.
Yeah. I would say, just because there's so many pieces to this, that another one that's important that comes to mind is understanding financials and understanding how to speak sort of financial statements. And without a grasp of your financial statements, even if you've only been in business for a year and there's nothing really meaningful there. If you don't have some financial literacy as a founder, it's a really difficult thing to overcome. And it's not something that you need to go to accounting school for. I think if you don't have any of those skills, my advice oftentimes to founders is like, do a YouTube workshop or something. There's a lot of tools out there. There are a lot of free tools out there. Venture Deals, the book by Brad Feld. I mean, that is just a Bible, and we recommend that all the time. But you can read that thing front to back, and it's all in layman's terms, but it really helps you understand, fundraising. And then the financial literacy piece is just like, it can be really daunting for founders, but that's another super important thing that, to me, like right away, sort of sets a founder apart from someone who probably has a lot more work to do.
Yeah, I mean, I've sold a couple of companies. I'm a sales guy. Like, I dig selling stuff. I'm a visionary. I can see things happening before they happen, and that's a real gift. And most founders are like that, right? They're able to see things other people can't, or imagine a world that is different as a consequence of what they're trying to do or build or solve. But when you sell a business, then you become financially literate, because I mean, like, if you go through a due diligence process, you're trying to, like, the acquirer is going to try to leverage you down. So you need to know literally every aspect of that business and how it translates into a price, because if you cannot justify the price, it's not too dissimilar from like an early stage, but it's just way more mature. So everything's bigger, more accountants, more lawyers, more brokers, all this stuff. And so like in every other guy I know that's sold a company, that's like a PhD in financial literacy, and it's accelerated because you're not forced to. Do you know what I mean?
Yeah.
Like you're dealing in like profit and loss. That's it. But like then there's balance sheets and all these other things. And it's like, Anyway, so on that bombshell, Joe, we can take a quick break and hear from one of our sponsors. The Matt Brown Show is presented by Carafin, an investment bank that offers and supports direct private investments in U.S. operating companies. Over the past 20 years, investors have placed over $1.2 billion of private debt and equity in more than 100 companies through Carafin and its affiliates. Carafin leverages technology to empower its community of investors to deploy their capital far more efficiently than ever before and connects their community of engaged investors with worthy companies. Invest portions of your portfolio in direct private investments today. Visit carafin.com/Matt Brown Show for more. So, Joe, when it comes to securities and structures of securities, is there a capital structure you prefer? So, if these guys are doing, $1 million a year, do you go convertible or do you price it? Or if they're pre-revenue, do you safe it? Walk us through how you approach security structures.
We strongly prefer priced rounds, and usually convertible preferred. And that's just because it's, you typically get the full enchilada of, understanding, what you're buying essentially. And that said, we do a lot of convertible notes, primarily for companies that either, need a bridge and are not ready to sort of price because they missed their milestone and they need just a little bit more capital to get there, or they're just too early and they don't want to value the company at $2 million and give away a third of it for that $1 million that they're raising. So we do that. We really try to stay away from safes. Safes, I think, again, if we already have all of the sort of proper and appropriate investor protections from a previous round, maybe a safe for a bridge round, but to sign up for a safe, especially with sort of state money, is just oftentimes not a very responsible thing to do. Even though you see a number of companies tending towards safes for the simplicity. I think you see less safes in Maine. It tends to be more of a West Coast thing. I think I might make that observation. I'm not sure if others would agree with that, but yeah, we try to discourage it with companies. Of course, it's all about leverage, as you know. So if a company if people are trying to knock a company's door down to invest, the safe can be very company friendly terms. And so if I'm a company and and I'm going to take money from folks who really want to invest, I would probably, think about a safe, but it's not, it misses a lot of the key points, and especially the key structures around the board and the information rights and things that I talked about earlier that are really important to us.
It's fascinating how safes came out of YC one year, and then everyone's like, "Oh, it's safe. Everything goes safe because it's safe," and it's just like. It's like, it's very interesting. And like, it's funny. Some people still, like I say, some of the guys I've had on the show, prefer safes if they're pre-revenue because it is simple and they don't have to, because remember, again, it also depends on context, because if your fund is $10 million and you're doing 2 and 20, your fees are actually, quite a thing. Like it can suck out any management fee quite quickly if you're having to price around with these pre-revenue, especially if they're pre-revenue. How the fuck do you do that? So
if you're more passive, right? If you're not going to be joining their board and really leaning in, like you don't really care about a lot of those nuances. So it can be okay for other investors, but there's it's not a great fit for us. And we haven't seen kisses. I'm not sure if anyone on the show has talked about those, but those are, in my view, sort of like a in between a safe and a convertible note, and they just have a couple more bells and whistles. But that's another one. Revenue-based finance is something that we've seen people in the region doing, and we've sort of been open to it. We have the ability to do it, but we haven't done it yet. That's usually more for a profitable company or company that's generating strong cash flow. And that's interesting because then you're not really needing that exit at the end of the road. You're just getting paid out over time through cash flow. And that's that's intriguing to us because it opens up an aperture of companies that otherwise wouldn't be exit oriented or are not looking to sell at the end of the day. And so that's, it's not something, again, it's not something we've done, but we're trying to get smarter on it.
Mm. Let's change gears. Have you had an exit in the portfolio? Okay.
Yeah, so we've invested in probably 100 companies over the course of time and had a couple dozen exits.
So how do you guys evaluate and prioritize an exit opportunity? Is it purely, do you leave it up to the founder? Do you just advise them as a board member? Walk us through that.
Yeah. It can be all over the map, but in general, we're investing expecting that there's going to be an exit in 5 to 7 years, plus or minus, and obviously we want to make sure we're aligned with the founder on that. What's happening behind the scenes is that the business obviously is growing to a size where it's getting the interest of potential acquirers. There's some, hopefully some attractive multiple that acquirers are willing to pay at that point once the company has really shown it can do its stuff. And if that takes, 2 or 3 years and the company is getting interest from acquirers, then that sort of naturally follows a path towards acquisition that, of course, the board will be very involved in, and the CEO will typically be running point. And sometimes it's been 7, 8, 9, 10 years, and that interest hasn't really been there. Maybe the company has even grown to a size that's suitable, but for whatever reason, it just is not getting the traction. In that case, we will start to sort of lean on the CEO a little bit to try to think creatively. How can we provide this off ramp for investors, either in addition to the CEO who might be ready to sort of punch out and go home, or in order to get off the cap table so the CEO can go and run the company how he or she wants to. And there's lots of different ways to synthesize an exit, as you know. So, we could start to proactively market the company. We could think about maybe other investors who are interested in buying out part of the cap table. So there are ways to think about it that sort of can achieve an exit without the big sort of celebratory event. And just like any venture fund, I think we expect and we've seen most of our investments are not going to be those big home runs, but and so you do have to, more often than not, you have to get creative about how and when to think about exit and those conversations.
For sure. So when you think about the world of venture finance, venture capital, Joe, what keeps you up at night today?
For me, being in Maine, the biggest thing that I think about is how do we grow what's going well here? How do we get more companies to come to Maine? How do we get more people to come to Maine? The governor's office put out a report a few years ago. This is actually just pre-pandemic. It said, in order for us to do what we want to do over the next 10 years as a state and make the gains that we want, we need a net increase of 75,000 new people coming into the state, which for Maine is a big number. And that translates through to the startup scene. And what I would love to see is, 2, 3, 4, 5x the number of startup companies that are cropping up here, to be adding fuel to, that innovation economy. And, I just think it's a really important part of the economy. Obviously, the big, capital intensive projects are really important too, but the startup that can become the next public company, even though those are few and far in between and might take a lot of different types of bets to get there, are super essential. And so, long way of saying, what keeps me up at night is just, how do we keep pushing this ball forward around not only supporting the companies that are here in Maine the best we can, but also taking advantage of this, really what I think of as a window of opportunity to bring more companies to Maine and more talent and other investors from outside of Maine that are looking at what's going on here and thinking, hey, there's some investable ideas. I want to support these companies too.
Yeah, it's very much an ecosystem challenge, isn't it? It's like, How do you get more of everything? right? Investors, startups, partners, people, 75,000, 150, it won't be enough. I think the UK government's also has been on a crusade for some time now too. My previous company, we won Africa's Best Tech Startup and went over to the UK for London Tech Week. It was a whole thing, and they rolled out the red carpet, obviously not only for us, but obviously for startups from Israel and Europe and South America and stuff like this. It's really quite a thing when you see a government get behind an idea and they roll out the red carpet. It's like, holy shit. It's like, it's impressive.
Yeah, I mean, it's interesting to look at other countries because I think the U.S., and this might sort of stray into politics a little bit, but the U.S. has, been very fortunate to be a country that, you've had a lot of innovators and entrepreneurs. It's sort of that's our culture, and Israel is another probably like the poster child for that. Super innovative, sort of just culture. But if you don't have that, and or you have challenges with immigration or some of the bigger issues that we deal with on a national scale, how do you still, set the right filters to get the good ideas coming in, but also do it in a reasonable way? So, it's interesting to kind of extrapolate what the challenges and opportunities that we deal with on a state level to what's going on nationally. And sometimes those track and other times not, but it is, in the U.S. anyway, the economic development, actual work on the ground tends to be, pretty localized.
Yeah. Tell me, how do you see the world of venture capital evolving, Joe, in the next 10 years, say? What do you think its impacts will be on founders?
Well, I got to believe that the trends that we've seen over the past 10 years are not only going to continue, but accelerate. And by that, I mean mostly sort of the software tools that have emerged to lower the costs to starting and scaling a company. So, if you think about even 10 years ago, but certainly 20 years ago, the idea of, leveraging a free CRM and a free accounting software and all these different pieces that you used to pay for and need to finance. Now you can sort of, if you've got a good idea and you can bring the support structure and the process around yourself pretty quickly and inexpensively. It creates just a much more fertile ground, all of these tools for more companies to grow and to grow faster. I think aside from that, there's the people component, right? Is how do you still have to solve, and this can only really happen on a human scale. How do founders meet? How do people work together, even if they've got, virtual reality headsets on and, they're operating in an immersive web or something. You still ultimately the currency of building a business is really around your communication with your team and how you identify, which talent you need and how to bring it on and how to integrate it to continue to add value for your customers. And so, I think that the tech tools are going to continue to grow, and I'd love to see more innovation around the human sort of relationship management and, because so many times, and you've seen this, I'm sure in your life, is how many times have you seen companies fail because of just the wrong mix of personalities and succeed because, the team was right. And if you can optimize better for that, that there might be some interesting sort of potential there.
Yeah. If you could go into the Matt Brown Show time machine, Joe, and go back to yourself on day one, before you got into this space, and thinking about all the things you've succeeded at, failed at, and learned, what would you do, or what advice rather would you give yourself on day one?
Yeah, I would have probably paid a little bit more attention to venture in my early days. So like I said, I was on the operating side of startups, and I ended up dipping my toe as an entrepreneur into starting a couple of my own companies, and just was really sort of naive about, even though I had been around venture funding and private equity more broadly, I was just kind of really naive about how it worked. And it was always, frankly, intimidating to me to try to understand it. I felt like every time I spoke with someone, or maybe watched a YouTube, interview, it just seemed like it was over my head. And so I shied away from asking questions. And I think, once I was in the industry and I was doing it on a daily basis, it wasn't something that was difficult to learn. It just required, like everything, repetition and focus. And so my advice to myself would have been sort of get smarter on how the PE world works in general. And I think that could have translated to maybe the difference between failure and success with some of my earlier enterprises.
Just to add to that, like slightly different context, but like before I started, I was like, man, it's like, because basically I was, chatting to startups, did like 170 shows, just talking to all these guys building amazing companies. And then like they're all raising money, or they came to me and said, hey, can you help me raise money, whatever. But like I'd never, even like interviewed a venture capital person at all ever. Because never had the opportunity, because now I came to the States, suddenly it was like, oh shit, like everyone's here. So and it's amazing to see how it's always the same. It's kind of, and it doesn't matter, like I remember I I set an intention to interview all the sharks from the Shark Tank, right? And I was like, oh, these guys and these girls, like they're so amazing, and like I could never, like, you know what I mean, like you always, like, you have this imposter syndrome thing, and But the moment you start to, and then I interviewed all of them, I was like, fuck, they're exactly the same as me. Like, there's no difference. You know what I mean?
Did you reach that goal of interviewing all of them?
Yeah. I've had like billionaire, like the who,
like really,
I've been really lucky, man. Like to have the people I've had on the show. And when they sit there, I remember, I was like, funny side note story, but I remember I was busy, right? And then I was like, shit, I got this podcast coming up. And then like I jump on and it's like scramble, turn on the lights, and I turn it on and I'm like, and there's Jeffrey Moore is like sitting there, a guy who wrote Crossing the Chasm, like one of the like go-to Bibles, you mentioned the word earlier, for like scaling a company or a technology product company, and it's like that's how it goes, and then you meet Jeffrey and you're like, oh, he's just like me, like he's got a specialism, of course, but like there's really no difference. And I guess the point I'm trying to get across to everybody is, if you're curious about something, to your point, like get in there, like get in there and start talking to people, because it's like once you've done one, you've done 1,000. Do you know what I mean?
Yeah,
that's how.
Yeah, and also, and asking questions when you don't understand. I mean, VC is like notorious, and I try to not do this, but I'm sure I do it all the time, for using jargon that just is like, it's not actually a very sophisticated concept, but the jargon is a language of its own. So that contributes, I think, towards the perceived, impenetrability, but it's really not that. And I also times I want a founder to tell me, I don't understand what you just said, as opposed to sort of trying to figure it out after the conversation ends. And I understand that impulse. That's me a lot of the time, but it's refreshing to have someone say, like, sorry, you need to break that down. And it just means that I'm not doing my job communicating. I think I look at that as a positive if someone's asking me to better explain myself.
Yeah, someone once said to me, how do you know if your communication's any good? Well, your communication's only as good as the communication you receive from others.
Yeah,
right?
Absolutely.
So there you go. Joe, thanks for being on the show, dude. It's appreciate your perspective on the private placement perspective series. Really great to get to know you. Stick around, and everybody else, I will speak to you all again soon. Thanks, Joe.
Thanks, Matt.